So let me quickly introduce myself as well. I'm Sheetal and I have 13 years of experience into financial services. I have spent my time at Kotak, ICICI, and now I'm leading a team at Jiraaf. Alongside me is Prateek, who is a head of strategy in Jiraaf. So Prateek has over a decades of experience across banking, private equity, and venture capital. He started career with Royal Bank of Scotland in Hong Kong with investment banking and capital allocation team. Also, Prateek is an alumni of IIM Ahmedabad. So here we are focused on educating investors on fixed income investment products. So together we'll be exploring some fascinating insights into fixed income investments. So before we dive in, let me share a quick story. So just last month, we saw a downtrend in the market with both the Nifty and the Sensex indices experiencing notable declines. So the Nifty 50 dropped by approximately 2.61%, while the Sensex fall by around 4.13%. So it was a stark reminder of how the volatile markets can be. So during this time, what was my key takeaway was to avoid timing the market and use tax harvesting to optimize my investments, keep liquidity, and also diversify with fixed income investments. So today we are excited to share these insights with you and discuss how we can navigate such market challenges together. And also we'll have a question and answer session at the end of this webinar. So you can feel free to ask the questions or any queries you have. So over to you, Prateek.
Thanks. That's very kind, Sheetal, and good evening to all of you. A gentle reminder that in case you have any questions, please use the Q&A box at the bottom of your screen to type in your questions. And as Sheetal said, we will try and take all of them towards the end of this call. And as Sheetal rightly said, the context that over the last 3 months, Nifty has seen a significant decline. This is not new. This happens in the market. It's just that since 2008, we are used to easy capital being coming to the market, which has given returns, which at the surface looks high and seems a very convenient way to actually create capital. But if you look at a 30-year history, you look at more developed markets, especially like the US, and see maybe a 50-year history, you would find that they are balanced portfolios that make the most money over a period of time. And fixed income is an essential component of it. Fixed income essentially comprises about 30 to 40% of a balanced portfolio. And then comes the more market-linked assets, be it mutual funds or be it equity. And with that context, maybe I will take the liberty of sharing a few slides, and that then can set a little more detail into what we are seeing. Where we are today, if we look at the last 6 months, the returns have been negative 11.7%. I think all of us would be familiar of it. This is, I would say, this is not much of consequence. Markets will have their own up and down. So I will not dwell on this particular part. You look at a zoom out a little bit and you look at a 1-year picture, that's about 4.9%. In the year of turmoil, you could perhaps have been better served by investing simply in a fixed deposit, a AAA bond. Certainly, if you were an yield seeker, a 10% A-rated bond, all of them would have beaten the Nifty, certainly in the last year. Zoom out a little more. Let's go for a 3-year return. The aggregate return is about 33. The CAGR is still 10. And now when you are looking at a 3-year history, this is the post-COVID world where governments had put in significant amount of money. Fair enough, the economy was coming out of the COVID turmoil. But this is generally also regarded at a period where Nifty has done very well. So if you ask any analyst and they would say, yes, the Nifty has done very well. And that CAGR is still only about 10%. Let's zoom out a little more. Let's take a 10-year history. We are still at a CAGR of 10.6%. Now we have covered significant ground. We have covered COVID in the middle. The dip that you can see around April 2020 is the COVID dip. But you have seen that over even a large span of time, the CAGR rate is still about 10.5% of the Nifty. And we are just taking Nifty 50 as the benchmark for understanding markets. I'll zoom out a little more. Maybe a 30-year history, which is from 95 to about 2025, the CAGR is still around only about 10%. So it begs me to maybe think about saying that, look, how should I allocate my portfolio? Now, one of the most convenient argument is that the CAGR works when you've put money and you've forgotten about it, and year on year it is simply compounding. You've put 100 and that has become 3 times, 4 times over a period of a decade, where then it has given a CAGR of 10%, but the wealth has actually compounded 3 points. The analogy to that would be, if you invest in a 1-year bond of, let's say, doing 12%, you take all that proceeds of the bond and put it again next year in the same bond, then next year again in the same bond, basically mirroring the compounding effect which the market has, you would have actually beaten the Nifty in that same period. That is why I think when you look at larger and larger time spans, it is very, very critical to understand that returns are pretty alike on the risk return spectrum for either Nifty, public markets, or bonds. The risk return equation, irrespective of the instrument, be it fixed income or be it equity, would be determined by the amount of risk that you take. So if you're thinking that, look, markets are safer or Nifty is much better than bonds, I am trying to make the argument that it is actually not. It is probably worse off than a simple A-rated bond. I will also explain the risk of an A-rated bond so we understand how to benchmark this. Now, coming to our current topic as well, what are the risks in a particular market? They will always be volatile, as Sheetal said. They are also susceptible to entry and exit points. For example, if you invested 2 years ago at the top of the cycle, your returns are probably negative at this point. Similarly, if you invested in maybe 2018, you are looking at a very flat return at this particular point in time, because the markets average out over a period of time. That's the same logic that you apply when you're investing through a SIP. That's the same logic that all the associations tell you to invest in a mutual fund. But if you're investing directly in markets, you are subject to volatility. This volatility, the market volatility, can be avoided in fixed income. The point of fixed income is, irrespective of what happens in market, your returns are determined by credit risk, which is underlying in a bond. And irrespective of what happens in the market, the issuer of the bond has to pay a fixed return, which is known to you the day you invest. The third part, of course, is like we are in a current cycle when the markets are below, then all of us tend to realize that what it takes to have, and why is it important to have, a very well diversified portfolio. If we take all the global studies, all of them will indicate typically a 40% portfolio in fixed income, typically another 40% in markets, and 20% would be either in hard assets or in alternate investments, depending on your risk appetite. I think the point there also is, if you look at the history of Nifty in India, we had the Asian crisis in 97. We had some impact of the dot-com bust in 2000 and 2001. We had some impact from the global meltdown in 2008. We had some impact from the European crisis in 2012. We have had a demonetization. We have had a GST. We have had a COVID. So events like this over a 30-year time span also tells you that the market's volatility will continue, and events like this will continue to happen. They are influenced by geopolitics. They are influenced by various other factors structural to the economy. And that is why any investment in market is prone to risk, which again brings us back to the importance of having part of your wealth in a fixed income portfolio that gives you the security, that gives you the fact or the belief that your core savings are not being eroded away and are compounding over a period of time. Then you can be more comfortable also taking market risk, saying my core base of income, my core base of wealth generation is already set. And that is why we again come back to making a diversified portfolio. I'll also illustrate this, the same point that I was saying. The red bars that you see on the graph are again periods where markets have not yielded returns. And if you look at the graph, we'll try and clean it up next time we bring it up. But this is a graph from 1995 to 2025. There have been areas where for about 3 to 4 years, the returns have been zero on Nifty. So it makes it very, very important for you to understand at what point to enter the market and what point to exit the market. And that information may or may not be that readily available. It might not be possible for all of us to track that information as aggressively. I mean, in today's market, again, now there are two views, whether it is a good time to buy or whether that's still a time of caution. And that will always happen in times of volatility and in times of turmoil. There would always be multiple views. That is why it is even more important to have a part of your portfolio in fixed income and then be less worried about timing the market as the only way to creating wealth. The second part, of course, why we believe that this is a good time to be in fixed income is we are practically at the peak of a interest rate cycle. There was a lot of easy money floating around post-COVID. The Federal Reserve raised rates and has now begun the cycle of cutting these rates. And as the rates will come down, specifically on the US Treasury 10-year bonds, we have had RBI cut down the rate once already this year. It is widely expected that the Federal Reserve will cut rates at least 2 times in this year. That's been the commentary from the Fed last night when they chose not to cut rates last night, but they've given a commentary saying they expect to cut rates by at least 2 times in the coming year. RBI is also likely to follow. As these rates will come down, the returns on bonds will go down. The returns that you're earning currently on fixed deposits will go down. The markets will continue to be choppy. So before the rates actually go down, this might be a very good time to lock in, to purchase a bond, to lock in a particular rate, be it 9%, be it 10%, be it 11%, whatever risk level you are comfortable with, and have a very deterministic portfolio where you're not subject to volatility and when you're not subject to uncertainty. One of the other underrated benefits of fixed income is actually predictable cash flow. If you invest in a bond, you know whether your money is coming on a monthly basis, whether your money is coming on a quarterly basis. If you have planned expenses, you can still grow your wealth and still be prepared to meet that expenses because the bonds are predictable. I have met several people in the last 3 months who were banking on purchasing an asset by encashing their mutual funds, and when the market tanked, you can't actually encash them out because the corpus is not enough, and it's probably the worst time to actually cash them out. So one of the other underrated troubles with equity markets is they will always be susceptible to cash flow risk. And when you actually need the money, fixed deposits or bonds are better. Fixed deposits less so, because again, you will have to wait for maturity. Otherwise, they will have a penal point there. On bonds, you would know exactly what your cash flow is. The two quotes at the bottom, I think they are also important. One is from Rick Reeder, who's a global CIO on probably the most well-known fixed income investor, BlackRock. The other is also Anders Persson from CIO of Nuveen. Both of them are simply stating that given where we are on the yield curve, given where we are in the rate cycle, this is probably the best time to lock in yield and participate in fixed income. The market volatility has also opened up an opportunity. So again, I would suggest to you that when you take a 15-year view, and that is how investors of long term should think, you should then do an asset allocation basis a 15-year view of your own portfolio. Ultimately, compounding happens over a large period of time. It happens in the markets, it happens in fixed income. You should then see the market at that duration of returns. The short-term bubbles will come and go. I touched briefly about the risk of bonds, and this is a study that CRISIL had done. The CDR here means cumulative default rates. So the message I want to say is when we think of bonds, we actually sometimes don't understand the underlying risk of a bond. And that is the worry an investor would have, saying, I don't know if an A-rated bond is safer or not. I don't know if a triple B is safer or not. My expectation is that only triple A bond is safe. But what is safe? I mean, if you put money in a fixed deposit, and there have been instances in countries where countries have gone bankrupt and the fixed deposits have not been honored. There have been sovereign bonds that have been issued. Russia has defaulted. Argentina has defaulted in the past when sovereign bonds have not been honored. India has never had a case when sovereign bonds have not been honored, so we've been lucky in that sense. But essentially, this table here depicts the cumulative default rates over a 10-year history of each credit rating category. So if you take a AAA bond over a 3-year period measured over 10-year time span, no AAA bond has actually defaulted in the last 3 years, right? And this is again the number of issuer months you can see. This is history coming from nearly 16,000 issuers there. If you take an A-rated bond, the chances of default in a 3-year period are 0.7%. So maybe 1 out of 100 or 0.7 out of 100, that's the risk of someone going in. I will also highlight the fact that even if a bond defaults, the chances of capital recovery are reasonable because there are underlying assets. There is a recovery process. In a listed bond, there is a SEBI registered trustee who will enforce that. There is a proper SEBI process by which capital is recovered. I mean, even in one of the biggest blowouts of debt mutual funds, investors eventually recovered all capital. So one, the default rate itself is low. Two, even in such a case, the chances of capital recovery are reasonably high. You take triple B assets also. Triple B assets in today's time yield anywhere between 13 to 15%, maybe about 12 to 14%. Even there, the default rates over a 2-year period is about 2.5%. If you're participating alternatively in a triple B bond for a 1-year period, the chances of default are about 0.52%. So then, if you have to compare risk and return, I think that would be a better way to maybe then think about your portfolio. I think one of the biggest misnomers in fixed income investing is that a lot of people don't understand how to quantify risk of a bond. While we hear about ratings all the time, AAA, AA, triple B, we don't intuitively understand what a rating means. And of course, AAA is safer than AA and so on and so forth. But how safe? So this slide, I'm trying to bring out the point of what is the probability of default of each of these ratings of bonds. And then you can decide for yourself that if the probability of default is 0.5%, would you like to take up a 1-year bond, triple B, and lock in a yield for 12, 13% for yourself? Whereas vis-a-vis facing the volatility of a choppy Nifty. This graph essentially again denotes where we are in terms of credit products versus public market equities, the return and risk expectation. Typically, the bond and public market equities are actually not that further away. The perception of gap between equity and bond sometimes comes through. I will maybe clarify also. If you buy a 10-year bond and if you stay invested in Nifty for 10 years, the benefit Nifty gives you is your wealth will keep compounding. In bond, it will come as a fixed return. But if you buy a 1-year bond and invest it again and again and use all the proceedings, the return will actually be the same. This is a slide to again highlight what's the gap in equity markets vis-a-vis global equity markets. If you look at the global markets, it's more balanced between equity and debt. Rather, fixed income markets are larger. In India, it's the reverse. Equity markets are larger than the fixed income market. That just shows that there is a lot of opportunity. There is a fair amount of democratization that still needs to be done in the fixed income space. There are more participants that are yet to come in the bond market. The reason Indian equity markets are ahead of fixed income are because of mutual funds that have taken off in largely in the last 20 odd years. It's also because equity trading has become very, very simple. Today, you have an app like a Zerodha or a Grow, and you can buy a Reliance share practically at the touch of 2 buttons. That ease and that convenience is something we are trying to bring together as Giraffe and as online bond platform. SEBI has taken various initiatives to try and bring more capital to debt capital markets, try and make them as convenient as it has been for all of you, the investors, to participate in public market equities. And Sheetal, maybe now you can take the audience through of what is an OBP and how does that work.
So thanks, Prateek. It provided a clear understanding of market cycles and how economic factors influences them. So now let's talk about what is an OBPP. So it's an online bond platform provider, is a SEBI registered platform that enables investors to buy and sell bonds online. So these platforms have gained significant tractions in recent years due to increasing retail participations in bond market. In November 2022, SEBI introduced a regulatory framework to ensure transparency, investor protection, and accountability for online bond platforms. This was driven by several factors. Because of a surge in online platforms offering bonds to retail investors, more retail investors started using these platforms, making regulations necessary. Also, SEBI aimed to standardize operations, ensuring investor safety and confidence in the bond market. So, with these regulations, the SEBI registered OBPs can facilitate online bond transactions, making the market more secure and reliable for the investors. So now let me introduce my platform. So basically, Jiraaf is also a SEBI registered online bond platform that empowers investors with access to high quality fixed income opportunities beyond traditional options. At Giraffe, we are making investments in bonds. The bonds should be simple, transparent, and accessible to everyone. So traditionally, these products were available to only few institutional investors. But we are changing that by bringing a new category of fixed income investments to individual investors like you. So we offer a diverse range of products, allowing you to compare and choose investments based on interest rates, credit rating. As Prateek mentioned, you can select ratings as per the issuer's credibility, tenor, and liquidity. So you can invest as per your financial goals. So all the opportunities which we are bringing at the platform are thoroughly analyzed by risk team, ensuring investor confidence. And last but not the least is a hassle-free digital experience. Investors seamlessly uh, uh, log in and complete their KYC through a user-friendly platform. Also, for all the new investors who are just exploring the bond market, we have investments starting from just rupees 1,000. So you can just try and test the platform, how they are working. The NCDs will be credited to your demat account. The cash flows are available when you are selecting the bonds. So you can just try it out. Try the platform. Also, we have a bond directory. If you are referring to any other, you are looking for any other bonds which are not available on the platform, you can just request for a quote. Our concerned team will get in touch with you. So now let me introduce my team at Giraffe. So at Giraffe, we are led by a seasoned and well-rounded in leadership team with over 120 years of experience into BFSI sector, with backgrounds in top global financial institutions. Our leadership brings deep expertise in corporate finance, investment banking, risk management, product development, and technology innovation. So let me introduce my founders. So Saurav Ghosh, with over 12 years of experience in corporate finance and strategic investments, having structured deals worth 12,500 plus crores across structured debt, equity, and asset monetization. So he previously led the corporate finance strategy vertical at Ozone Group and also worked with the Wadhwa Group. He is also an alumni of IIM Ahmedabad and BITS Pilani. On the other hand, Vineet has over 14 years of experience and he is an expert in investment management, structured debt, and mezzanine financing. He has successfully closed transactions worth rupees 8,300 plus crores across equity, debt, and real estate investments. So, as a founding member of Piramal Fund, he played a key role in scaling its AUM to about 58,000 plus crores. He has also worked at Axis Bank, focus on large-scale corporate deals. Also an alumni of XIM Bhubaneswar. So why this team matters for investors? It's because members have worked with top financial institutions like Kotak, ICICI, HSBC, Barclays, RBS, Piramal, and more, bringing deep industry insights. With extensive experience in credit assessment and risk governance, the team ensures that investments are secured and well structured. And led by experts in fintech strategy, product design, Jiraaf offers a unique and high yield investment opportunities. And last but not least, the team prioritizes on transparency, accessibility, and wealth creation, helping investors diversify beyond traditional assets. So now let's talk about the products which we offer at Giraffe. So if I talk about treasury bills, so these are like short-term debt instruments which are issued by government to meet short-term liquidity needs. These are considered one of the safest investments due to its sovereign guarantee. T-bills are typically issued with tenor of 91 days, 182 days, 364 days, and are sold at a discount to their face value. The difference between the purchase price and the face value represents the interest earned. These instruments are virtually risk-free and offer liquidity due to their short tenor nature. Listed corporate bonds. So these are debt securities issued by companies to raise capital. These bonds offer high returns compared to government securities, but come with a moderate risk depending on the issuing company's creditworthiness. So corporate bonds typically have tenor ranging from 1 to 3 years. They often provide higher yields. Yield would be ranging in between 8% to 15%, and are sometimes secured by corporate assets, adding an extra layer of security. Government securities and state development loans. So these are long-term debt instruments issued by central and state government. These securities are known for their stability and low risk due to government backing. So they have tenor ranging from 5 to 40 years and offer fixed interest rates paid semi-annually. So government securities and SDLs are ideal for long-term investors looking to preserve wealth and generate steady income with returns typically above 7%. SDIs, so securitized debt instruments. These are the financial products created by pooling various types of debts such as mortgages, auto loans, or credit card debts or receivables and selling them as securities to investors. Issued by financial institutions through SPV, special purpose vehicles. So we also have a SDI of AP Factor, which is live on our website. You can just explore the SDI section and you'll find two deals which are there of AP Factor. So SDIs also typically have tenor of 1 to 3 years, and the yields of these instruments vary based on underlying assets, generally ranging from 8% to 15%. We also have yeah. So these are the products which we offer at Giraffe. We have almost around 12 corporate bonds which are at the moment live on the website. So you can explore the investment range starts from 100 to 1 lakh, and the interest ranges in between 8% to 15%. What are the key benefits of investing through online bond platforms? So first of all, we have already spoken that these are regulated by SEBI. There is a transparency because these bonds are traded on NSE and BSE. So all the data is available As well as we have on the website, you can download the key information documents. You can easily download and go through it. Okay, smooth RFQ process. So whenever any investor is placing an order, the request for quote directly goes through to NSE and ensures that the transaction is directly going through exchange. Easy payment options. So you can make the payment through UPI. UPI limit is up to 2 lakh. Net banking also you can make the payment. So whenever you are raising any order on the website, so you have time till 10 p.m. You can make the payment through net banking. And also you can use RTGS NEFT for making the payment. So aftermarket order facility. So this is the facility which we are providing because usually the bond trading is in the market hours, which is around from 9:15 to 3:30. But we are facilitating the trades even after market. So even after the market, you can place the order. The request is being raised and you can make the payment and complete the order. So, and next point, if I talk about all the units which are settled. So all the units settles in T plus 1 day, which is a standard timeline mentioned as per the SEBI requirement. So if you are placing an order on Monday, the units will be credited to your account on Tuesday. Or if you are placing an order on Friday, you will get the units credited on Monday. It works on T plus 1 working days. So, robust technology framework to enhance customer experience. So, our platform, as I mentioned earlier also, so it's a very simple process. You can complete your KYC in just few minutes and you can start exploring the opportunities. There are also a lot of blogs and, industry insight articles which are available. You can go through it. You can explore the products and you can make the decision. Minimum disclosure requirements. So what are all the disclosure, all the documents which need to be disclosed, just like rating letters, KID, GID. So all of them are available on the website. So you can easily download and go through it. Lastly, investor grievance redressal mechanism. So if you have any complaints regarding your repayments or any delays in the interest payment, so you can reach out to us or you can write directly to our compliance team. So our team will get in touch with you. So let's now talk about different types of risk which are there in the bond market. So as Prateek already mentioned about default risk. So let's start with the default risk. So this is one of the biggest concern for bond investors. It refers to the possibility that the bond issuer, whether it's a government or a company, might fail to make payment or repay the principal at maturity. So for example, if you invest in corporate bond and the company goes bankrupt, so you may lose your investment or receive only a fraction of it. To mitigate this risk, investors should carefully assess the issuer's credit rating. As Prateek mentioned in our previous slides, that bonds rated AAA by agencies like CARE, CRISIL are considered the safest, while lower rated or junk bonds carry higher default risk but offers higher potential returns. Next is liquidity risk. So this refers to the difficulty of selling your bonds before maturity without taking a loss. So like in equities, they are easily tradable. In bonds, there is a liquidity risk. Unlike stocks, bonds do not always have a high volume for buyers in the secondary market. So, for example, if you owe a bond from a lesser known company and need to sell it quickly, so you might struggle to find a buyer. While to pay, it's difficult to find a buyer. While government bonds and highly rated corporate bonds, they tend to be more liquid, whereas low rated or niche bonds may carry a higher liquidity risk. Interest rate risk. So one of the most common risk in bond investing is the interest rate risk. This happens because the bond prices and interest rates moves in opposite directions. So when interest rate rises, the existing value of the bonds may fall, and vice versa. So here if we talk an example, for example, like if you buy a bond that pays a fixed 4% interest rate, and a new bond is issued offering 6%. So your bond becomes less attractive to investors, so reducing its market value. The long-term bonds are more affected by interest rate fluctuations than short tenor bonds. So you can choose, considering their time horizons and the current interest rate environment before investing.
I think I'll just come in on the risk part.
Sure, Pratik.
The interest rate risk, actually, from an investor perspective, might not be that relevant. And for investors, the reason we have put out this is so that you are aware. And as an investor and as a platform, it's our duty to keep you informed. But if you're holding a bond to maturity, you don't run any interest rate risk. Interest rate risk is good for bond traders, people who are looking to sell the bond, let's say buying now and selling 6 months down the line. But if you participate in a bond and hold it to maturity, which is maturity meaning towards the end of its tenor, your coupons are fixed, your cash flows are assured, you will get the money on the day of the repayment due date. There is, even if the interest rate changes, there is no risk to the payouts that are already fixed for you. Liquidity risk. Liquidity in India is tough. Bond markets, as I had mentioned, are underdeveloped. If you try and sell a bond on NSE or BSE, it might be difficult because the liquidity of such bonds is low. So the suggestion to investors is, when you are planning your bond investment, make sure you've checked the cash flows of the bond and make sure you are aligned with the cash flow as they will come. Don't bank on finding liquidity through an exchange during the tenor of the bond. We've talked about default risk in any case in some detail. Yeah, I think those were what the points that we had. I once again encourage the audience to put up their questions in the Q&A box. Sheetal and I will take them. We have our first question actually from Mr. Sai Krishna, who has asked, here also risks, right, if that company defaults. So the answer to that, Mr. Sai Krishna, is can a country default? Yes. Can State Bank of India default? Yes. Can Reliance default? Yes. Can a startup default? Yes. The nuance in all of that is, what is the probability of such a default? What is the probability a State Bank of India will default tomorrow? What is the probability a State Bank of India will default in the next 12 months? What is the probability a Reliance will default in the next 12 months? And similarly, if you're buying an A-rated bond of, let's say, Crazy Bee, what is the probability of Crazy Bee defaulting in the next 12 months? And I will refer to my slide back again. That is the study that CRISIL tried to do and quantify this, saying that, look, what is the probability of default? And then you can assess whether the returns are proportionate or in line with the risk that you're taking. There are no investments which are free of any risks. Maybe, Sheetal, maybe you can take this one. Mr. Ashok Tripathi has asked why TDS percentage is 25 in SDI.
Yes, so these are SDIs are basically pass-through certificates. Okay, so the AP Factor company, which is the managing this whole investment through an SPV. So they are giving the receivables to an SPV, and then the whole transaction is going through the SPV. So here it is 25%, but what you can means the return, it's as per the tax slab. And also, if you are selling these SDIs before 1 year, so you will incur a long-term capital gain tax, which is 12.5%. So even if you are holding this for a year and you sell this after 1 year, so you can make the capital gain in these instruments.
So yeah, maybe 2 points to add, Mr. Ashok. The TDS is determined by government. We don't have a say in it. Currently, the TDS rate is 25%. Actually, in this budget, the government has reduced the TDS rate to 10%. But because the finance bill is yet to be passed, that only becomes active in next fiscal. So as of today, as the law stands, the TDS is still 25%. Mr. Rahul Kapadia has asked, can you please share the presentation over email? Mr. Rahul Kapadia, I'm very sorry, we might not be able to do so, but we'll certainly be able to share all the relevant details that you might like. Please do write to us or please do contact our team and let us know what do you need specifically. If you need some of the background details, specifically default rates, specifically Nifty charts, we'll be happy to share that. But the proprietary material we normally don't share over email. There is another question from Mr. Naveen Bhati. I have a Wint Wealth account. Do you transfer my bond in the same demat? That's with Wint Wealth. Sheetal, would you like to take that?
Yeah. So, and in Jiraaf, whenever you are doing a KYC, so there is a demat account number which is being entered by an investor. So that demat is being verified, and then the units, the NCDs are transferred to that demat account. It does not matter that that demat is linked to your Wint account or your Zerodha account. The demat should be like the interest which gets credited to the investor goes directly to the demat linked bank account of the investor. So it doesn't matter that you have the account in Wint or wherever.
I think Mr. Sai Krishna has asked, can we see the bonds in between before they mature? Mr. Sai Krishna, yes, absolutely. The bonds are visible in your demat account. The bonds will also be visible in your Jiraaf dashboard. Before you make the selection, you can have all the details. You can go through the rating, the key information documents, all the material that we put out. And during the tenure of the bond, you will always be able to see them in your demat and your dashboard. You will have full access to know where the cash flows are, what has been repaid, and what is due to come and on what dates. So we try and provide as much information as possible, as conveniently and as transparently as possible. That's our core job as an OBP. The next question is from Ms. Usha Shivshankar. Hi, it was interesting webinar. Thank you for explaining. Thank you for listening in. Can the income from these investments be treated as income from a business? Unfortunately, no. These are treated as interest income. They will be classified as other income in case you have salary income coming through. So this will not be termed as business income. This will be termed as other income. Now there are tax set-offs between business losses and other income losses that are applicable. But if you are asking about specifically the classification of the income, this will be treated as interest income falling under the head of other income. The next question is by Mr. Jitendra. Sheetal, maybe you can take this one. Minimum investment in AAA bonds.
So it depends on the company, and the face value is very important in the bond. So minimum investment starts with 1,000 and it can go up to 1 lakh. Okay, and if there is any interest, if there is any principal payment, the face value of the bond reduces with the principal payment. Like suppose if 1 lakh is the face value of the bond and there is a interest, there's a principal payout of 25,000, so the face value becomes 75,000. So if any new investor who is trying to invest, they have to invest with minimum amount of 75,000 to invest in the bond. So triple A rated bond generally starts with 1,000 rupees.
I think Mr. Jitendra, the easy answer there also is please log into our website and you will know exactly what the minimum investment is. You don't have to remember all of this. Simply log in to Jiraaf and you will have a minimum investment and you will have choices in that minimum investment. So you can use it as per your convenience. The next question is by Mr. Sangamesh. Do I have an option to exit my investment before the maturity date? The answer to that, Mr. Sangamesh, is unfortunately no. As I said, the liquidity in bonds is still low. You can try to sell the bond on an NSE and a BSE exchange, but it is tough to find a buyer. So you must plan to hold the bond till maturity if you are investing. As the bond markets develop, and we are also taking certain steps in that direction, we hope we'll be able to facilitate an exit before the maturity date. But as things stand today, my suggestion would be to please plan for a hold to maturity scenario. and not rely on an exit during the tenure of the bond. A similar question by Mr. Sai Krishna. So whatever I invest, I can sell anytime from demand. The technical answer is yes. The practical answer is you will have to find a buyer, which may or may not be an easy task. This one also maybe I can take. Miss Usha Shivshankar has asked a second question. I agree it is safer to invest in safer bonds, but I assume that Jiraaf would have done all their checks before offering it to us. Miss Usha Shivshankar, the answer is absolutely yes. We try and do as much checks as possible. We have our internal credit process. Before any opportunity goes live on a platform, it typically undergoes a 2-month process where we do a diligence, we run a credit exercise. But all said and done, no investment comes without risk. It is our duty to continuously point out the risk to our audience and to our customers so that you are aware. Certainly, if you track our history, hopefully we want to be proud in 10 years and say that there have been no bond defaults on Jiraaf in a 10-year period because our credit processes work. Having said that, we will continue for 10 years to say that, look, all of these bonds do carry risk and customers should be aware of the same.
So we have an anonymous question like when the bond is matured, we have to sell the bonds or by default it is sold and the principal is credited to our account. So once the NCDs are credited to the demat account, the interest by defaults get credited into demat link bank account, and the principal also is credited to your bank account. You don't have to take any action regarding any of the NCDs which is there in your demat.
Yeah. Once you buy a bond, you don't have to worry about the money coming to your bank account. All the bond in your demat account, the account that is linked to your demat account, will automatically receive all interest and principal payments that are due on the respective due date. There is a SEBI registered trustee that will have to oversee that process, and they are quite diligent about it. So yeah, once you buy a bond, you don't have to worry to check whether the money has come in or not. Of course, you can tally your bank account statements, but there is no actionable at your end after you purchase the bond. I'll take, there's another question from Mr. Ashok Tripathi. It means that if I invest in an A or triple B rating bonds, there are much chance to default, and triple A rated bonds giving less percentage, they are same as bank FD rate. Mr. Ashok, if I have understood your question right, on the risk return curve, A would be less safe than AAA. A triple B would be less safe than A. The question is always how much. The slide that we have currently on tries to depict that. And yes, I mean, the more you move towards the safer assets, the less the yield would be. You're also right that the AAA bonds are very similar to bank FD rates. If you really think about it, some of the banks, which are small finance banks, are much, much smaller entities as compared to the companies that are actually issuing a AAA bond. For example, if you have a Suryodaya Bank, that's a small finance bank, is a much smaller entity than a Shriram Capital or a Reliance Capital or Reliance Industries, who have issued these bonds, and their cost of debt then would be accordingly. The benefit you have, of course, in a bank FD is there is an insurance coverage up to 5 lakhs that's applicable, that's there. Next question is by Mr. Sangamesh, and Sheetal, maybe you can take that. Do we have a Jiraaf mobile app?
So currently we do not have a Jiraaf mobile app. We are soon launching the app, maybe in by first week or second week of April. So you will the RM will, you can get in touch with your relationship manager. So they'll be sending the communications on the app launch.
Yep, we hope that the app is available to all of you quite soon. We are targeting hopefully in the next couple of months, and we would welcome all feedback that you would have on the app. We look forward to your participation in the same. The next question is by Mr. Sai Krishna again. What are your platform charges? At the moment, there are none. We are trying to facilitate as much as possible to our customers. The way we make a little bit of money is if the bond price is 12.6, maybe we will offer it to you at 12.5. But once you see the rate and once you participate in a bond, there are absolutely no charges to the investor. So before you put your money in, you exactly know what your money is going to be, what are the returns going to be. There are no charges upfront or at the back, you will know your exact cash flow. Mr. Sangamesh has asked, will you share the recording of this webinar? I think the answer to that is yes. We will email you, and a recording of this webinar would be shared out. Good. I think with that, we've also unfortunately come at the end of our time and of this session. If there are still any pending questions, please do write to us, or you can reach out to any member of our team. We'll be delighted to answer them. If there are any other data points that you would like, or any other topics that you would like us to cover in a future webinar, we'll be happy to do the same. We thank you for joining us this evening. Thank you for your time and your attention. Sheetal.
Yeah, thank you all. Thanks for your time, taking the time for joining the session. The recordings will be available on our Jiraaf Knowledge Center section under webinars. So you can just go through all the webinars which are there on which we have so far done, and all the recordings are available there. And apart from that, if you have any queries, we have a very good supports available on the platform. Also, your relationship managers, you can reach out to them for any queries. We'll help you to solve your queries on time. So yeah, thank you.
Thank you. Thank you very much.